You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to Infinite Banking Mastery. I hope you all are enjoying the beginnings of spring as much as I am. I mean, it was really beautiful for a while, and then it did drop right back down to freezing. But lately, it's gotten a little warmer, and I am enjoying more of the light in the evenings. Today, I thought we would get into more of the mechanics of how a policy works and what it looks like to borrow against your policy. Let's start from the beginning. When you're just starting to think about funding your policy, the premium dollars. Most times when people think about life insurance, they're thinking, ew, I don't want to spend a ton of money on this, and nor do I want to think about dying, even though that's the one thing that's 100% guaranteed to happen in your life. Basically, life insurance in general, to most people, is more of a morbid topic, something they don't want to think about or pay very much for, but most times they do see the value in it, especially if they have a family. But once my clients learn infinite banking, their mind tends to take a U-turn and they start to see how amazing this vehicle can be. Every single client that I have ever taught who fully understands what's happening has always asked me, how much can I put in? In fact, I have a fun client story to share. Years ago, I went over to see a married couple, and it was because the wife really wanted coverage on her husband. This happens a lot, actually, where one spouse wants the coverage on the other. But she really wanted the coverage on her husband because he was the one who was working and she was home taking care of the kids and taking care of the home. And so he was bringing in the income. So she wanted that extra protection. And so she asked for me to come over and talk to them and just help them with some sort of life policy. So as soon as I got there, the husband was immediately very defensive. He was saying, look, lady, I only have like $100 a month. Not even $100 is too much, actually. I have about that much. My budget's super tight. I don't have any more money to put into life insurance. I really don't want life insurance. I just want the least expensive thing that you can do for me. And so I said, sure, no problem. And so we took a look at what would work for that budget and that amount and tried to get as much coverage as we could for as long of a time period as we could using term insurance because that is the least expensive. And then at the end, I said, hey, but would you mind if I just shared with you another idea, just something that maybe you don't want to do it today. It doesn't sound like you want to do that today, but I just wanted to share it with you in case at some future point you might want to look into this strategy. It's a different type of life insurance. It lasts your whole life. It's guaranteed to pay a death benefit. And there's just a few things I could just share with you. And then if you want to learn about this more in the future, I'd be happy to go into that with you. And a policy we're applying for right now, the term policy, is actually convertible to this type of policy with no health underwriting if you choose to change the type of coverage that you have. And so he said, okay, well, go ahead and share what you have to share. I already know I'm not going to want to do that. I'm just going to want to stick with what we already have drawn up. So I shared with him just a few introductory concepts of infinite banking. And by the end of that, I didn't even give him a full teaching, just a really light introduction. And when I was finished, he said, whoa, I think I want to do that. I have $15,000 a year. That's what I want to do. And I said, no, that sounds like a bad idea. You said you only have $100. Your budget is tight and you don't have very much money to put towards this. And I don't want you to go way outside of your budget and move forward with something that's too difficult for you to sustain. So I don't know. That sounds like too much to me. But he was insistent and he wanted to move forward with that. And so we did. It ended up working out. He did have that in his budget because he was saving those dollars for something else or into another type of account. And so we moved forward with that and they've been excellent clients ever since. But that's just one of my fun stories from, client who just didn't really want to talk about life insurance. Okay, so once you understand and are ready for your own policy, we will start with how much premium you want to pay. how much do you want to begin your banking system with? A lot of people will ask, how much do I need? How much do I do? And I'm telling them, you tell me how much you'd like to begin with. And you can start at almost any amount. There are some restrictions, but I almost never run into a problem. Remember that the more that you fund into your policy, the larger your pool of cash will be to finance your future purchases for things that you want, need, or desire to invest in, and ultimately have access to in your retirement years. Imagine if you had your own actual bank. Where would you deposit your savings? Into your own bank or into someone else's bank? I would think you would want to put as much money as you can through your own bank as possible. Okay, so once we have an amount of premium to begin with and begin the policy, do you have access to all the money that you just paid in year one? Nope, not yet. You have to start thinking of this like a business. Think about it as if you were creating your own real bank. Would you have access to all the money you just paid to set the business up? What would it entail to even set up a bank? You would have to have at least $20, $30 million to get started. And then you would have to go and try to get a bank charter and all of that. I often compare this to the first business that I opened, which was a coffee stand. It cost me about $40,000 to open this business. And, after I spent that $40,000, which was to dig for sewer water, put the building up, electricity. Now I know this is a lot more than a lot of people who build espresso stands put into it, but that was my path. A little crazy. But doing all that, I spent about $40,000. And the next day when I had done all of that and had everything ready to go, my commercial refrigerator, everything's ready, I did not have access to any of that $40,000. Of course not. All I had was some milk and a little black book of phone numbers from customers who said they would come back once I built this new business up, and a lot of prayers. And so I just said, I didn't have any of that money back. I just invested that money because my intention was to have a business that was cash flowing, to have a business that would bring me cash flow and profit. And so that was the whole reason why I put in that 40,000, was to have something that was going to be cash flowing to me. And so when anybody opens a business, they understand that that money they're investing is not going to be money they're going to get right back out. So same with the life policy. We can't expect to fund our banking mechanism that we expect to bring us cash flow, like a business or rental property, in the future, and then expect to have access to all the funds right away. When you buy a rental, you are buying it for the rental income and to have someone else pay off your asset for you. But when you do so, you have to put money down and sometimes even fix the place up. You might invest a pretty penny before you see anything out of it. Same sort of thing with your policy. You will not be able to borrow out all of the money that you put into it in the first year. But the reason you are starting a policy is for the future cash flows that it will generate. In addition, it will take a while to have access to all of the money you put into it. This is called the startup cost of your system, just like a business. In the first years, you won't have access dollar for dollar to all the money that you put in. But then, if your policy is built correctly, it will begin to create cash flow. Soon after, your policy will break even, and then it will never look back. And in the meantime, while your policy is building up steam, you are protected and have access to a portion of the death benefit for a critical, chronic, or terminal illness. You are building a legacy for your loved ones, and you have access to the cash value in the account to borrow against it for something you need, want, or desire to invest in. So let's just say that 10 years into the contract, remember, you don't have to wait that long to borrow against it. This is just an example. But let's just say you have $100,000 in the contract at year 10 in your cash value account, and let's say you needed $100,000 to buy some property that you wanted. Here's the magic, folks. You are able to borrow against that $100,000 while keeping your $100,000 in your policy, still earning guaranteed interest and dividends. This is where you recognize the power of uninterrupted compounding interest, because your funds continue to grow as though you never touched them. And you didn't, because you borrowed the insurance company's money to make your real estate purchase. Every year, your cash value builds like a snowball, rolling down a hill, no matter if you borrow the funds for another use or not. But using the funds and creating more cash flow opportunities that you can then cycle back into your policy is where the power of IBC becomes amplified. Now, once you've taken that loan against your funds, the best thing to do is to create a loan repayment to yourself, to your account, in order to replenish the funds so that they are ready for you to recycle and deploy again for another use. You can do this as many times as opportunities that arise. And by flowing payments back to yourself, the funds will be there again when you're ready to start taking income in retirement, and so then can start pulling funds for your retirement. At that future time, we will shift how we are taking funds from the policy so that you will be receiving the income tax-free and also not have to replenish the policy. One thing people will say to me sometimes is, I actually like to buy things in cash so I don't have to have any payments. I just save up all my money and then go out and buy things in cash so I don't have credit card debt and all of that, which, is good. But isn't the action of saving money into the bank every single month the exact same as repaying the life insurance company? Whether you create a loan repayment of $300 a month or save $300 a month to your savings account, $300 a month is going out of your checking account from one place to another. Why not have your money working harder for you and accomplishing many more things at once, allowing you to capture the earning power of these dollars, rather than sit in your savings account to let the bankers loan out as they please to make a bunch of money? One of my favorite quotes by Nelson is that you finance everything you buy. You either pay interest to someone else or you give up interest that you could have earned. Now, by doing things this way, by saving into your policy first, we are capturing and earning that interest rather than giving up the interest to someone else. Because every time you hand away money, whether it's for a purchase or to pay off debt, you are giving up the opportunity to ever earn on that money again. This is what's called opportunity cost. In this case, it's where you are missing out on the gain that your money would have earned because you gave your money over to someone else. You are letting money flow through your fingers and missing out on the opportunity to earn on them. But by implementing the infinite banking concept, you will be able to capture the earning power of many more of your dollars before you hand them away, before you hand that money over to someone else, and that will amass great wealth for you. Let's talk about the premium a little bit. When I fund the premium, it creates cash value, and then I have access to that cash to take policy loans. The premiums are two-part. One part is called the base premium, and the other, the paid-up additions. The base premium is what's supporting the death benefit on your contract and the portion of the premium that is not available in year one. This is the majority of your startup cost. The paid-up additions is the part of the premium that becomes readily available as soon as you pay it into your contract. Sending the paid-up additions portion of your premium to your contract is like moving money from one pocket to another. It becomes available right away. This is the portion of your payment that is fueling the growth of your system, that is turning the typical, dare I say boring, whole life contract into a powerhouse used for infinite banking. The paid-up additions part of your premium is what's making your contract more cash efficient. It's what turns the focus of the contract from the death benefit to the growth of your cash instead. When people out there say, oh, don't buy whole life, it's not a good investment. Well, first of all, remember that it's not an investment at all. It's an asset, and an appreciating asset that will grow despite leveraging the funds inside to fund major purchases, pay off debts, or invest in something else. But what they are referring to is the traditional way of building the contract. Building it the, quote, regular way will not yield anything amazing in those first years anyway. And you will have access to almost no cash in year one when you're building it this more traditional way. But building the contract for infinite banking will have a different structure, and this structure will fuel the growth of your cash. That's why it's important to work with someone who knows how to structure these contracts in favor of your cash to grow. Now, once you've borrowed against your contract, remember that you are in full control. And any good IBC practitioner will tell you that you need to create a loan repayment to yourself with interest. But if for some reason you're unable to do that, or you go through a period of hardship, you can do whatever you want, whatever you need. You can pay interest only for the life of your contract if you needed to. You can create any payment that you want back to yourself that's comfortable and fits your schedule and for any amount of time that you want to pay off this debt. You can take a few months or even a few years off and pay nothing back to the contract if you were unable for some reason. And you can also pay back the loan in full with no penalties. The choice is yours. This is unlike any other place that you are able to borrow money from, because anytime you borrow money, you must start repayments right away. This is just another awesome feature of the infinite banking strategy. Remember that in last week's episode, I said that taking loans just to take loans doesn't do really anything amazing. It does nothing to amplify the growth of your banking system. But if you have money that you are planning to use for something else, like paying off a debt or buying a car in cash, and instead you redirect it to your banking system by paying premium dollars, either new premium, a new policy, or adding to the paid-up additions, this is what's going to really amplify your system and create way more value for you in the long run. It'll allow you to capture the earning power of your dollars that you would have otherwise handed to someone else and would never have earned on again. Now you will earn on those dollars for the rest of your life. And of course, after putting those funds into your policy, you will have access to them to do exactly what you initially intended. Okay, so I've said many times that with a policy built for infinite banking, you will receive guaranteed interest and also dividends. There's just one thing I want to mention again, or I'm sure I've mentioned it before about the dividends, is that they are not guaranteed, just like any dividend with any company. Any insurance company can miss a dividend in any year. The good news is the companies that I work with haven't missed a dividend. For one of the companies that I work with, that would be over 130 years since inception of the company that they have never missed a dividend. The company paid dividends through the Great Depression, through 2001, through 2008. They have an excellent track record. Well, that wraps up our topic for today. I look forward to sharing again next time, where I will continue talking about the structure of the policy. And so we'll be sharing on how to keep the policy growing and accessible, income tax free. As always, if you would like to talk about how a banking structured life insurance policy could work for you, please reach out to Valerie at alphaomegawealth.com and we can find a time to connect. I hope you have some beautiful spring weather where you are in your area to enjoy now that lovely spring has started, and I hope that you have a great week.
This is the podcastfactory.com.